Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is February 26th edition of Market Outlook. So, roaring close on Friday, yet another good week. Let's take a look at the overall action and see what that pertains. So, first of all, as you can see, 1 week price change up uh, almost 1%, not quite there, but still overall a really pretty good solid week. And the exception was the Russells, which were down about 0.5% for the week. So the hot index right after the election definitely taking a pause. Now, what's interesting, as you can see on accumulation versus distribution days, is that definite selling in what was once the leading index after the election, with really strong accumulation days in the diamonds or the Dow, the S&P, and the NASDAQ. So interesting rotation, not all that unexpected considering just how strong the Russells were. And as you can see, over the last year, up 35%, and that's relative to a 25% move in the other indices. So it's just sort of taking a pause and a bit of rotation. What is a little bit more disconcerting is the absolute volume level. So even though we hit new highs this week, the S&P 500, the SPY, 2 weeks ago traded about 380 million shares for the week, and we were down to just over 300. So we had about a 25% drop in volume as it's making new highs. Now, you add that together with this next analysis, and you get another pause about what's happening here in the market. So, taking a look at this, utilities, right, which is a safe haven move, over the last 5 days has been up 4%, where the S&P 500 only up 0.8%. So light volume, rotation into safety. Now, of course, this is interest rate sensitive, and the rates definitely have come off a bit. But the other interesting things is that financials, transportation, and semis were all marginally down on the week, while the rest of the market was up. So definitely rotation or a pause on the leaders, moving into more conservative things on lighter volume. Okay, let's take a look at some other things that are happening here. Um, as you can see, natural gas, energy, definitely under pressure. Metals, for the last 5 days, and these are more industrial metals, under pressure as well. So that's interesting. Some pressure on what would be considered more inflationary type things, but again, that's more of a pause, and the overall trend looked like we were getting a good movement into economies related to commodity prices. So as you can see, copper also down over the last 5 days as well. So the movement, the initial movement into commodity-related things on pause for this week. Now, the other thing that I had noted last week was that you had the hedge fund blow up, and even the other anomaly, so this is interesting as well. The anomaly is that volatility, even though the market was up, also moved up. Now, that could be due to the liquidation and the dislocation from the mutual fund slash hedge fund that had been short volatility and really got crushed. It's down, I don't know, 25, 30, or even 35%, and that is HFXIX, and that has definitely dislocated the option market and volatility, especially in the S&P 500. And so you can see, despite the market moving up, volatility moving up as well. Okay, let's take a look at some of the market internals. And as you can see, we actually, started rolling over. We're in the S&P 500 in terms of up-down volume on a short-term basis. We're just sort of holding the midpoint here. So that's sort of a neutral reading. Same thing with the McClellan oscillator. Really hasn't been able to get going to the upside. Sort of paused here. So I give that a neutral. And advanced declines, doing okay. So I give this a neutral, right? So market internals on the S&P 500, a neutral. Another thing I want to point out is with utilities outperforming the S&P as strongly as it has, some of our other risk-on, risk-off indicators are definitely showing some signs of being tired on the risk-on side. So things like SPY versus gold and high-grade debt or high-yield debt versus the U.S. Treasuries, definitely under more pressure as well. So a couple of warning signs here that are showing up. Let's take a look at a couple of other indicators. Okay, in the S&P 500, looking at new highs, new lows, can't really argue about that. Really, new high, new low ratio in very positive territory. You can say basically the same thing for the NASDAQ 100. So the up-down volume, advanced declines, looking a little iffy. Volume definitely light. Let's see what else we have to look at. And as you can see, volatility just sitting right under the 50-day moving average. So you want to come back to the site and watch for a spike above, because that would definitely be a warning sign that things are definitely a little bit too frothy and volatility is picking up. Already, as you can see, we're not making new lows in volatility as we had been as the market was moving up. We're sort of sitting sideways. So let's watch for a pop above the 50-day moving average or even the Bollinger Band. That would definitely be a cautionary sign. But so far, we're not there. We're going to let the market tell us when. Okay, same scenario in looking at 30-day volatility versus 3-month. We actually crossed under the 1.2 level, which had been important support, and now roaring back through it. So in essence, this indicator has moved back into positive territory. So let's just keep an eye on that. Can't really say anything other than this is a positive to the market. Okay, so that's really wraps it up for now. Again, price structure looking pretty good. The issue is some of the market internals definitely looking iffy, and this weak volume, extremely weak volume, is definitely troublesome. All right, hope this helps. See you next week, and bye for now.